Welcome, everybody. Happy Wednesday. Thank you for joining our webinar today. If you have any questions throughout the webinar, please put them in the Q&A. We will go ahead and monitor that Q&A and either answer those questions as they come. If they're specific to our offering, we'll probably wait till the end and then answer them all at once. So don't worry, we will get to them. So if you have something, go ahead and drop it in there. And again, we'll get to them as we go. So we'll give everyone just one more minute here. See, it looks like we still have some people joining.
One thing I want to add, Lauren, is just that both of us are not investment advisors, tax professionals, CPAs. So everything we provide is for educational purposes only, and we're not your attorney, accountant, or financial advisor.
Good call. Be too careful these days. So with that, we'll go ahead and get started. So today we are going to be talking about evaluating deals and sponsors and different investment, I guess you could say, asset classes or categories. So we're going to start with, again, high-level overview. If you haven't joined us already, who 7E is, our backstory, Chris and I, how we got into this. We're going to talk about active or passive investing, types of funds, and evaluating a sponsor, and then we'll open it up for some Q&A. But like I mentioned a moment ago, if you do have questions that come up, please drop them in the Q&A, and we will have them all there at the end, or we'll be able to answer them as we go if they're relate to what we're talking about. So anything to add, Chris? We didn't introduce ourselves. My name is Lauren. This is Chris. We are the co-founders of 7E Investments. And really, I think it's important, and I think it's important a little bit about where we come from and how we got to where we were today. You can see that at one point we were actually sitting in your very seat, or I was at least. Since I've been doing most of the talking, Chris, I will let you go first.
Yeah, thanks, Lauren. And as Lauren mentioned, I am Chris 70, one of the founders, along with Lauren, of 70 Investments. And as Lauren mentioned, we've been in your seat and we still are in your seat. Lauren and I invest passively as well. But with our fund and how we got here where we're at, I started in the W-2 world for many years. I started, if I dated myself, back in the late 90s. And during that entire time, I was always really just banking on my 401k. And that's what I was going to use to retire. That's what we had. And it wasn't until a little over 10 years ago, actually, when I started really getting focused on building my own portfolio, whether it was being active or passive, which we'll talk about today. And then it was that 40-40-40 rule that somebody mentioned to me of working 40 hours a week for 40 years to get 40% of your income. And I am getting closer to that 40 years in the workforce every single day. And you need to have something just outside of that 401k and be involved. And to me, it was having passive, but also getting active. And mortgage notes was something I fell in love with 8 years ago, almost 10 years ago now. And started doing that with some of my own funds, joint ventures. And then Lauren came on board and helped me. And ever since that time, we've been able to expand, grow, and provide the types of offerings that we'll talk about today. Lauren, I'll let you take it from there.
Yeah, same but different. I went to university, got a corporate job in software sales, and also was coaching a local high school water polo team or helping like assistant coach. And I realized most of the parents on the pool deck that were at everything, games, practices, everything in between, either ran their own business or invested in real estate. And so I started looking into that. I didn't have kids at the time, just disclaimer. But I knew I wanted kids. And I knew I wanted to be actively involved. So I started looking into real estate. I eventually stumbled across mortgage notes after attending probably over 100 different webinars, seminars, in-person meetups, and whatnot. And then started, again, similar to Chris, built my own portfolio, met Chris at a conference, and then we started working together. And then we launched our most recent offerings together over 2 years ago. So both been in the space for just under a decade and have done 5 full cycle offerings, but we'll talk about that later as well. So with that, next slide. Did you have anything to add?
No, I was going to say,
Okay.
does it pop up to who we are and what we do? Pop up on your screen?
No, now we are.
Okay.
Yep, that's how 7E Investments came to be. We are a Virginia-based private real estate investment company focused on buying and selling mortgage notes that are secured by single-family homes. So we like to say we fix and flip mortgage notes. I'll talk a little bit about that since I don't believe we talk about it too much later. But essentially, we are buying notes at a steep discount, anywhere from 30 to 60% value. And then we are able to work with the borrower, get them reperforming, meaning paying again, and sell it back onto the secondary market for a profit. So there's a lot that really goes into that. And if you're interested in our due diligence or really the ins and outs of what we do, have some other webinars on our website that you can reference. If that's something of interest to you, feel free to email me or my team and we can get that to you.
Yeah, and one thing I just want to add is that you mentioned, Lauren, too, is we are vertically integrated, which we'll talk about a little bit more later, meaning we have everything done in-house, our accounting, asset management, investor relations. And the other thing that I just want to add is we focus on the mortgage industry. That's all we do. We're not doing short-term rentals. We're not investing in crypto, oil and gas, or other types of alternative investments. This is who we are, and this is what we do, and this is what we want to focus on. And our mission is democratizing investment opportunities and providing that win solutions with borrowers, which one thing that's unique about this space is that win solution, meaning it's not a net sum zero. Just if a borrower wins, it doesn't mean we lose. If we win, doesn't mean a borrower loses. There's outcomes that is part of what we do, benefits both parties. Now we'll talk about the active versus passive types of funds.
Yeah, so typically when people get into this, they think, or maybe it's just me, oh, I'm going to be a passive investor. I'm going to own rental property. And then you realize that owning rental property is definitely not passive unless you're outsourcing all of the management, paying someone else to do it. So really, I think the first step in when you're evaluating a deal or what avenue you want to go down is knowing, do I want to be an active investor or do I want to be a passive investor? So typically with active investing, you have more control over the decisions. There is a little bit more flexibility and some possible tax benefits. The cons are it's more time consuming. You're having to source your own deals. You're doing your own due diligence. All of the things that go into that you typically a sponsor would do, you are doing on your own or with a partner. There's a higher barrier to entry. So again, depending on how much liquid cash you have available, what can you invest in? And it's more costly, more to lose. So you're really, unless you're diversifying into multiple different things at once, you're really tied to that one or two assets that you're investing in. And then you have passive investing. Pros, zero time. You're literally sit back, you're collecting a check, you're diversifying investments, and there's typically sometimes can be a lower barrier to entry. So as opposed to active investing. Now, the cons are you don't have as much control. You have to have some trust, and I'd say a lot of trust, not some, in the people that are running the fund. So the sponsor is what they call them. And then there is the ability for lower returns in comparison to active investing. So I think when people get into, I want to invest outside of the stock market, okay, do you want to be active or passive? And then thinking, okay, what is my bandwidth and availability to do so? Do I have a W-2 job and two kids under 5 running around, or do I have more flexibility? And what are my commitments at this time? Can I be a little bit more on my own? So, Chris, do you have anything to add to that?
Yeah, I think like for me, the mistakes I made early on in my active passive is, and I think most people have this issue, is they overestimate their abilities on like time. And I used to have some rentals, and then first I didn't have a property manager. Now I'm like, oh, I can handle this until the 3 things break and it's on a Sunday. And then all of a sudden you're like, I don't have the time for this. Then like life changes, I with kids. And then the other component to that is I'll just mention people think they're passive when it's really not. Even right now, I have some rentals that I have property managers for. But if you have an issue with a tenant, a lot of times that can't be resolved with the property manager. Again, you have to get involved, and it's really, you have to be in the know and stay aware of things more than you typically do on the passive side. And the one thing I'll just mention on the passive side is once you get through that upfront due diligence, which we're going to talk a lot about today, then it's just a constant monitoring of the situation, which truly is more passive, just like owning Amazon stock, essentially. So the 3 main categories of investment funds that are out there typically There's the tax advantaged, reduced taxable income, some tax-free growth, can use for long-term planning. People might use a self-directed IRA as an example, or 1031 into a DST. Now, those are some tax advantage categories. Another is income, which is what we here are at CWS. We focus on generating regular income. Investors who want that steady cash flow, typically on an income play, it's less risk on a growth play because on the growth, you're banking on that increase in value over time. Multifamily deals 5, 6 years ago were growth plays that did excellent. Today, those growth plays are not doing as well in many instances. So understanding the differences between those is really important, and understanding that income plays don't compete with growth plays and growth plays don't compete with income plays from a returns perspective and a risk profile. Anything else you
Yeah.
want to add?
Yeah, so I'm looking at it as I'm going to be talking through this about as through an investor journey.
Mhm.
So you decide you want to be passive, then you're asking, okay, what do I invest in? I want to be a passive investor. So that's where these categories come into play. Are you looking for to some tax advantaged funds? Are you looking for income specifically, or are you looking for growth? And typically a portfolio has a good mix of the three, but by knowing what you're looking for in this phase in your life, as I'm sure you can imagine, certain buckets attract different phases and ages of life. You'll be able to then dig into, okay, I know I want income. So here's 4 funds that I'm interested in that are income specific. So by knowing that, if you're going to call an income fund and ask for growth, you're probably going to be highly disappointed. And vice versa, if you're calling a growth fund for consistent income, you might be disappointed, or tax benefits on a growth fund. While there might be some tax alpha, that's not the main driver of that specific fund. So really important to know what you're looking for before you even take that next step. And
So
so,
go ahead.
oh, go ahead.
Okay. Types of assets. Most people look at the real estate, stocks and bonds, oil, gas, private placements, syndications. And one thing that you'll constantly hear us throughout is the considerations. Really, it's that risk tolerance compared to that risk return profile. And then the market dynamics. For example, today, the Fed cut rates by half a point. 3, 4 years ago, they went from 0 to 5%. Now, those dynamics have significant impacts on these different asset categories. Understanding your goal. What are your goals as an investor? What are you looking for? Lauren just talked about, which did an excellent job, by the way, on that past slide of income growth and tax deferred. And then that time frame. How long? What's your horizon? What's your time frame within the investment that you're looking for? People have different opinions where people like the liquidity of, oh, I want to be able to pull my money out in a year. For me, I'm the exact opposite. If I can put something in a fund for 3, 4, 5 years and keep it in there, it just saves me from having to find a new investment in 12 or 24 months. So, Lauren, anything else you want to add on type of assets?
Yeah. So again, going back, okay, you decide I want an income fund. We're going to focus on income, obviously, since that's what we do here at 70. You say, okay, I want income. Income's my main category that I want to invest in. I want to find something. This is then where you go to look at different types of assets. You can look at income funds that are in real estate adjacent, debt funds, private placement, syndications, oil and gas. Like you're able to find income within these different asset classes. So I think sometimes, yes, there are some that are more, for example, oil and gas, you're typically going to look at a tax play there. So there are some that lean into certain categories more. But once you decide, again, which category you want or you're looking for in your portfolio, then you'll be able to say, okay, what asset classes are attractive to me that provide income, for example. And then you get to say, okay, I've identified 5 income funds that are super interesting to me. Then you have to put them side by side. And there's the sponsor, which is very important. They typically call people like Chris and I sponsors in this world. If you didn't know that, super fun. So I'll refer to people like us who run funds as sponsors. So you obviously you want to do your due diligence on a sponsor, and that's super important because that's that control piece you're giving up by not being passive. Now, then you look at, okay, what's available to me? Now, depending on your accreditation status, you're going to have more available to you if you're accredited versus non-accredited. So typically there's kind of 2 types of primary funds floating out there. You have your Reg A and your Reg D. Now, Reg D is much more prevalent. and you have to be an accredited investor. There aren't any requirements to report to the SEC, and there's really no qualification costs. And offering size, there's no limit, meaning they could say, I want to raise $500 million, and that's fine. Submit it to the SEC, basically tell the SEC you're doing it, and be on your merry way as long as you're only accepting funds from accredited investors. Now, the Reg A has a lot more to it. It's better in that even if you're accredited, there's typically a lower barrier to entry with Reg A. So Reg Ds, typically you're looking at 50, maybe 25K, but probably 50 or 100 as your like bare minimum investment.
1,000.
Yeah, 1,000. Yes,
Yeah.
good call. Yeah. So your Reg A, there's a limit on how much can be raised. So you can only raise 75 million in a 12-month period. It is open to accredited and non-accredited investors, and you can publicly solicit for that reason. You have to file an offering with the SEC and provide an annual audit, and they have to be qualified. They have to qualify you. So not only are you with the Reg D, you're just saying, hey, I'm going to do this. This is how much I'm going to raise. This is my investment thesis. Here you go to the SEC, and you're again on your way. With the Reg A, you're going back and forth. They're asking you to clarify things in your offering circular. And then again, you're paying the SEC qualification process and auditing costs on an annual basis. So it is held to a higher level of scrutiny because you are accepting money from accredited and non-accredited investors, and the SEC's job is to protect investors. Now, something that's been interesting to see in our world as I'm traveling more to meet with financial advisors and brokers is that a lot more in the past, when we first launched this Reg A over just under 3 years ago, we were one of the only Reg A's out there in the institutional broker dealer and RIA space. Now I go to a conference. I was at one earlier this week in San Diego, and I think every other sponsor we have a Reg A coming soon. We have a Reg A coming soon. And something that was really important going back to our mission statement was making opportunities accessible and available to everyone. Accessible in that you don't have to be accredited, and available in that the minimum can be significantly lower. So I think it's interesting to see how this is all playing out with more and more Reg A's hitting the market now, or supposedly the qualification process has become very stringent, as it should. So we'll see how many actually get qualified, but yeah, just some evolution there over the last 2 years.
Yeah, a few things I'll just add. Like on the Reg D, with an accreditation status, it's a little bit more like the Wild West in the sense that a sponsor can put a PPM together, which is a private placement memorandum, which is here's what the fund is investing in and here are the rules. But it's technically not required. And the SEC looks at it from a standpoint of you're an accredited investor, you can lose money, essentially, is more how they look at it from that perspective of you're investing 50,000. If you lose it, okay. And there's been funds over the last several years as shifts in the economy where multifamily deals, they've lost everything. And people are now going back asking, oh, do I have recourse? And then typically that Reg D, it's very limited unless there was a true fraudulent act that took place. The Reg A is much more scrutinized. Like you said, you have to have the audited financials. You have to submit to the SEC every 12 months to requalify the offering. So there's a lot more information that is publicly available because with the Reg A, it has to be public that people can see this information. And from an accreditation standpoint, what is the definition of an accredited investor versus a non-accredited investor? Recently, they adjusted the accreditation status to individuals who hold certain series licenses, 765 or 82, people who have a net worth over $1 million individually or combined with a spouse, excluding your primary residence, or if you earn over $200,000 a year or $300,000 combined. One interesting fact that I find interesting thing there, the numbers for accredited investors is from like 1982. So think about what 200,000 was worth back then, which was right around the time Nolan Ryan was the first major league pitcher to make $1 million in a year compared to, what is it, $50, $60 million a year, some players making now. So they've never adjusted those numbers over the last 40 years. They're talking about it because about 40% of investors are going to become accredited in the next 5 years. And accreditation is really meant for a different class, is what they've mentioned. Non-accredited is basically anybody with the acumen and experience to evaluate those risks, but doesn't meet those requirements as an accredited investor. Anything you want to add, Lauren?
Nope. Perfect. I'm glad I didn't cover that on the previous slide for sure. I almost did. So going down that pyramid, you decide you want to be passive, you're income focused, you've chosen your asset classes, you've researched and found a couple sponsors or funds that you're interested in that are income plays. Then you see, okay, they have a Reg A, they don't, they have Reg D, but I'm still interested. And then you're looking at the sponsor specifically. Who are they? Who is the team? Are they outsourcing things, which typically leads to less, not less oversight, but things just don't get done as quickly. It's why everything is for us in-house. What's their experience? Have they had any prior funds go full cycle? Do they have a track record verification report? So again, being in this institutional space, working with brokers and RIAs, investment advisors, we've learned a lot about kind of their standards of due diligence on us. And so this track record verification report that we had to get by a third party, that this is all they do is audit how you report your returns and your past funds. And did you actually do that? And is it correct? Do they have anything like that? Because anyone can put together, I'm not saying anyone would, but it's a lot easier to say things on your website than have something to back it up. Do they have reviews or testimonials from previous investors, or do they have a list of investors that you can speak with? Not a list like all of them, but do they have investors that they're willing to let you connect with and pick their brain? What are their previous returns? How did they get into this? How long have they been doing it? So all the things, can you get on the phone with them? And when you call, are you speaking with them? Are you speaking with someone overseas? Are they able to connect you with someone in the office? I think these are all important questions, is again, giving up when you're going from active to passive. If you've decided to be a passive investor, you are giving up that control that you have to the sponsor and allowing them and trusting in their decisions and their expertise. So I think these are all very fair questions to be asking.
One thing I'll just add who they are in the team. You hear a lot of phrases come out there about co-GPs or co-sponsors, which is a group of different companies that like merge together, and one might raise money, one might do this. And as a passive investor, I've looked at several and trying to understand their track record and just get an understanding of what is your involvement in this deal? What are you doing? Are you just raising the money? Do you have any involvement after that fact? Like, and we'll talk more about transparency and kind of red flags down the road. But that's also very important, is who they are, but also what are they doing as part of this offering, or what's their role? From a compliance standpoint, you want, as you vet a sponsor, it's important to understand the type of offering and do they file the proper documentation. I've seen people offer a Reg D offering and they've never registered it as an exemption with the SEC. Just because you're exempt from filing, you still actually have to file something saying, hey, I'm doing this, because they also have to file paperwork in each state. So there's a lot of simple things that as a sponsor you can do to make sure people have those licenses to operate. And look over the documents, the private placement, but not only yourself. I always recommend just having an attorney take an hour to review and talk to you, like we mentioned here, to review those to say, what's the risk involved? Or if you know what hits the fan, what is my recourse? What can happen if something goes wrong? And you always, while you meet somebody and you're interested in investing with them, I call it the honeymoon phase, where you also want to understand what could go wrong and just understand the risk and what would happen as part of that. Anything else, Lauren?
No, it's good.
You want to start on this one?
Yeah, so I think these are some good questions. Again, this is all under evaluating the sponsor and the investment thesis, I guess you could call it. What is the company's exit strategy on their assets? What happens if interest rates, for example, if interest rates rise, does that affect them? Clarify how and when you can exit the investment. So if it's a 3-year term, do I get automatically recommitted for another 3 years if I don't let you know immediately? Or kind of what does that lock, they call it the lockup period, look like, and what are my options after that lockup period is over. Ask about risks involved and what risk mitigation practices they have in place, understanding worst case scenarios, where are you in that capital stack? Chris, I'll let you explain more about that. And then reviewing their historical performance or track record and the asset class's market resilience in general. Again, for example, tying it to interest rates, how this asset class thrived at 3%, but now we're at 6 and they're getting crushed. Not us. I'm just saying in general. But I think all these are important to understand and get to know how the sponsor evaluates and mitigates risk. But I think the capital stack, especially today, is a really important thing to understand. So Chris, you do a good job explaining kind of that capital stack.
Yeah, and if you think about a building, you want to be as close to the ground floor as possible in the capital stack. And any sponsor gets money from several different sources. There could be debt, which is if it's a multifamily deal, they will go to a bank and say, I want from the $10 million deal, give me $7 million from a bank. And then there's equity, and there's two types of equity. There's preferred equity and common equity. And the closer you are to the bottom, of course, the lower that risk. And when you have that debt component, which, and I'm going to start with a multifamily deal, and then I'll talk about our offering to share the differences, the bank gets paid first, and then the investors, and then typically the common shareholders or the profit split. So if there's a preferred return in an offering of 8%, the bank, then the investors, then the profit split. But what happens if that $10 million property all of a sudden is now worth 5? Now you don't have enough to pay off the bank. So they either preferred equity and common equity lose everything, or there's something called a capital call, which is they have to go raise more money to reduce the amount of debt. But when they raise that money, they're basically just putting you in the elevator to go up to another floor. So you're getting further from the ground level, meaning just if there's a fire in the building, it's harder for you to get out of the deal, and there's risk that you don't get out and end up with nothing.
One question that, or one thing I thought about it when you were talking about the sponsor, but at the sponsor level, I think it's important to ask the question, are you the one like doing the investing? Because there's a new type of fund out there, and I have nothing against them. Some of them are run really well, but it goes to that control. And maybe I'm just a control freak. So to me, I would take pause with this. But if you're looking at someone, it's called a fund of funds, where they're just raising the capital on behalf of another sponsor. So you're investing with them, and they're taking that money, investing it with on XYZ fund. Now, okay, maybe that works. Maybe they're great at raising capital, but if things go sideways, you're 2 degrees removed from the actual sponsor. Your information will be coming from the person, the fund that raised the money to then invest in that sponsor. Again, there's nothing wrong with that, but if it comes to control and communication and that is something that you're really interested in, then I would make sure that when you're speaking with the sponsor, that they are in fact the one making the investments and doing the due diligence, not just raising the capital. I think that's something that I didn't really understand at the beginning, and there are some pros to it, but again, with Reg A coming out and again lowering that barrier to entry, it's something that really doesn't make sense to me anymore to give up more control.
One last thing, I'm just going to jump back to the capital stack that I didn't mention, is as you move further away, that higher risk should have a premium, meaning a better return. So that's one thing we see a lot of people talk about is, oh, this only pays 6%, where this one I can get 13%, but you're, so far away, your risk profile is significantly higher where you could lose everything compared to, again, what Lauren started way back when on an income play. That income typically has a lower return, but also has that lower risk profile. You want to talk about transparency and communication?
Yeah. So you understand their risk, you understand their track record, you're looking at who they are, but then how do they communicate? Who are you speaking with? Do they send monthly newsletters, quarterly newsletters to their investors? Do they send, what does that look like? Can you talk to the team? if you call, who's answering the phone, and then do your principles and interests align with theirs? Again, this is really about how transparent are they? If things do go wrong, are they going to communicate that, or are they going to glaze over it? I think there's two different ways to approach that. So I think that understanding what your communication need is as an investor and how you like to be communicated with, if you want to speak with the in-house team or maybe you don't care, but what's important to you, does that align with what you are expecting of the sponsor that you're investing your capital with?
And just remember, some sponsors don't have a team. It's a one-person show, and that's that one person. So just understand that component as well. So what are some of the red flags to look for when vetting a sponsor? We just talked about communication. Poor communication or lack of communication is critical to understand. And one of the things that I do when I go to invest is I ask for, send me the last 3 pieces of communication or newsletters that you sent out to your investors. Show me how you report. Show me what you share with them so I can see how you communicate. What are you sharing? What information are you sharing and what is not being shared? Another is lack of experience. I think with a lot of FOMO happened over the last several years with ability, and you didn't need to have experience in the space and you could still raise money. There was a famous developer that made the news down in Houston that they came from a tech background. They took a training course on how to raise money and they raised 100 or $150 million for his multifamily deals. And they all went belly up. But if you went to the website, and this is part of what Lauren mentioned about like people and team, and you looked at their team, they had asset managers. But if you looked at the LinkedIn profile that they had on their website, there were virtual assistants overseas. So how do you have an overseas virtual assistant manage a $30 million property in Houston? So that's some of the things that red flags you really want to understand is where are the people, what's their experience? Conflicts of interest really lie into how many funds do they have? Are they shifting monies and assets between the different funds? Are they, who are they
Well,
buying from? Go ahead, Lauren.
yeah.
You.
And on the fund of fund perspective, are they raising capital for how many funds are they raising capital for? Is your money all in a single pot? Like, I think it gets a little hazy with that as well.
Mhm. And the last is high fees. And I was reviewing an offering about 3 months ago. And actually, just it was a mortgage note offering. And they had fees, but their fees were based off of the payoffs of the loans. So if you're buying loans at a discount, let's say $1 million loan, you're buying it for 700,000, they're charging fees based off the million, not off of what was raised, not off of what they're paying. And then if you have an acquisition, disposition, monthly fee, if you're getting feed to death, what incentive is it for the sponsor who's making all that money up front to really push it, especially if they're giving up a significant amount of the upside as well? They've already got paid. So it's just like when you hire a painter to come to your house. If you pay him up front, now you think typically is that quality going to be the same as if you pay him when the job is completed? So anything else on red flags, Lauren? This is one we could talk
No.
all day about.
Yeah. And I think the reason like this was a webinar of choice is because of my probably and Chris's, but just the meeting with these investment advisors, meeting with these other sponsors, meeting with at all these conferences and seeing, oh, like these are the red flags that I'm hearing that advisors look for. And so wanting to bring that, I am again really passionate about the education component of it.
Now we'll talk more about 7E and our CWS offering. And first, we'll just start. What is mortgage note investing? And it's an alternative investment strategy. As Lauren mentions, we'll talk about how we fix and flip mortgage notes. But we buy loans from banks, credit unions, other funds, and we purchase these loans at a discount. And what we're buying is that future pay stream from that borrower. Now, if you own a home, you may not even realize this, but after you sign all the paperwork and they tell you where to mail your payment, 90 or 120 days later, you're getting a letter saying, okay, now send your payments to XYZ. Your mortgage is sold. So somebody bought that, and whether it got put into a mortgage-backed security, wherever the case may be, that was sold. So mortgage note investing happens every day with more than 50% of the mortgages. I'll let you talk about the fixing and flipping component.
So how does it work? So I related it. I did not think this slide was in here. I'll be perfectly honest. So I need to review that next time. So we fix and flip mortgage notes. Similar to fixing and flipping a house, it's a concept that most people can understand and resonates with them. So we are buying these loans on single family homes at a discount to their unpaid balance. We are then negotiating. There's kind of two routes. More common route for us, about 90+% of our portfolio, is negotiating a payment schedule with the borrower. Now, we do a ton of due diligence on the back end into this borrower's situation and ability to repay, alongside obviously the due diligence we do on the asset itself. Now, if that's something you're interested in, I will go on all day about that. So there is another webinar specifically on our due diligence process that you can either ping us about and we'll send to you. But essentially, we're negotiating a payment schedule with the borrower. We're putting them on a 6-month trial payment plan, because the thing is, most of them are able to make their monthly payment. It's really just the past due balance. And when they fell behind, typically because of job loss, divorce, health, or I can't think of the fourth one right now. I wanted to say health, job loss, divorce, or death. Yes. When those past due kind of built up, they go back to the bank. Banks are notoriously inflexible if you can even get anyone on the phone. And the bank says, we'll apply that to your past due. They're never going to get caught up. They'll have late fees and past due, and they'll just continue to build more of a past due balance. Now, what we do, because we're buying it at a discount, is we're able to put them on a trial payment plan, because most of them, again, can make their current monthly payment, mortgage payment. And then after 6 months, we will modify the loan. So we don't touch interest rate. We will either extend the term, they'll make payments towards their past due quarterly, monthly, whatever that looks like. And then, so we're generating revenue from the trial payment plan. And then the 6 to 12 months after that, where it's been modified, that we're holding on to it to make sure we can get it back to a performing status, meaning paying on time as expected. And then we will sell it back on the secondary market, or the borrower will sell the home and we get paid off the full balance, or they might refinance and pay off the loan. So there's quite a few different exit options here. And then the second exit strategy, or the second kind of bucket of exit strategies, is when a borrower decides not to work with us for whatever reason, we will then, as we are the lender of record and are assuming the position of the bank, have the ability to foreclose. So we will go through that foreclosure process. Typically, we don't take back any homes. They are sold to a investor who is getting a deal on a home at an auction. So we just get paid off the full balance of the loan, plus any recoverable legal fees that we paid to get it through foreclosure.
And
Chris, anything to add?
Yeah, I'll just add back to vetting a sponsor. If you're looking at a note fund, it's important to understand what are they targeting, because I know funds, all they want to do is foreclose on assets, and they want to foreclose, take the property back, renovate it, and then sell it. And that's a very different exit strategy than what we do, because we have, as you can see, multiple exit strategies. In that instance, you really have one, and you might be much more susceptible to interest rates and property values, which on this next slide that we have, we talk about our investments have that significant equity. Now, as an example, a $250,000 property may have a loan balance of about $100,000. And how do we get that, or how do we focus on that? A lot of loans we'll look to buy are pre-COVID. They're 6, 8, 10 years old. And what happened during COVID years? Everyone's home, everyone that I know, their home had significant appreciation. If you bought a house in 2017 for $150,000 and say you had a $120,000 loan, you slowly pay down the loan, but your value has increased significantly. And those are types of loans we look for in Target. And then if we're buying it at a discount, in this instance, we'll just use 50%, that investment to value is 20%. So if property values do come down in our situation by 10, 20%, and property is now worth 200, the borrower still owes us 100, so they're still protected there, but that initial preservation of capital, that initial investment, is also thoroughly protected. Anything else you want to add, Lauren?
Nope.
So
yeah, so we have our Reg A offering. It is open to accredited and non-accredited investors. We have a 4-year term. At the end of 4 years, you're able to redeem your initial request redemption of your initial investment plus any bonus shares if you were awarded bonus shares, which leads me to our minimum investment, which is $5,000. However, we do start awarding bonus shares at $25,000, which essentially think of it like a little bit of equity you're getting up front. You're able to accrue 8% annually and get paid on that on any bonus shares and redeem the cash value of those bonus shares at the end of the term. Then a targeted preferred dividend of anywhere from 8 to 10%, and that really depends on the bonus share tier. If you are at one of those tiers, that would increase that return.
One thing I'll just add with the term, after 4 years, you can keep investing or you can pull it out. It does not reset for another 2 years or 4 years, like Lauren mentioned earlier. Something to be very important too, because you don't want to get caught where, oh, I didn't miss that little window like you have with some of your subscriptions that you have that, oh, if I didn't do it on the first full moon before the closing month, it renews for another year. And then you try and argue with them and they're like, nope, we just want to keep your money. For us, after that 4 year period, you can withdraw the full amount a little bit or keep the full balance in. This will answer one of the questions that Wayne had, so I'll let you talk about this.
So it is open to both qualified and non-qualified accounts, so self-directed IRAs. We do pay dividends monthly. It is and give you a timeline on that because this isn't the case. This is actually another good question to ask, like how quickly is my capital put to work and when do I get my first dividend payment if you're looking for income specifically. So for us, for example, anyone who invests by the end of September, their shares are issued October 1st and your first dividend payment would be November 1st. Am I doing my month correctly? I can't believe we're already in fall, so I'm
November.
like, wait, am I really referencing November? It is a non-correlated asset class, so really not correlated to the stock market and the whims of the stock market. We do have that collateral coverage, like Chris showed you earlier. We seek up to 4 times collateral coverage. So the market would have to absolutely be obliterated for us to be underwater. It is not a blind pool. So we're not raising capital. Again, another good question to ask. Do you have assets currently in your fund? Are you raising capital? Do you need to hit a certain threshold to build this development or invest in this apartment complex or whatever it might be? So blind pool refers to the fact that we already have an active and running portfolio and we are constantly raising capital and deploying it into more assets. We don't have any fees. All offering expenses are paid by the sponsor. And then from a tax purpose, for tax purposes, it is a 1099 dividend. However, I am not a CPA, neither is Chris. And so we do not give tax advice on how this could affect you individually. That is a question definitely for your CPA.
I'll mention Wayne asked about like qualified dividends. It's my understanding if somebody holds if you hold a stock for more than a specific period of time, then it kicks into that qualified dividends. And our offering, again, there's a 4 year hold period on that time, which if you talk to your CPA about that, mine, again, this is just mine, not yours, had mentioned that would be considered a qualified dividend, but always consult your tax advisor.
So is the dividend paid monthly? Here, I'm going off track. Let's get back to
Okay.
the Q&A.
Yeah. So a little bit about our experience. As Lauren mentioned earlier, we've managed 5 prior funds, and we also have that track record that we've provided. Our team is vertically integrated, meaning our accounting, investor relations, asset management, everybody is in-house. Everybody is here within the continental 48 states. We have never missed a distribution, but we have to mention past performance is not a guarantee of future results. We have done 600 plus notes. Total valuations on these assets are 100 million. We've been in 40 states. We've got 70 years of combined experience between our entire group. So it's not our first rodeo. We have gone through and built this team together and wanted to really focus it in regards to our experience and working with our investors. And then if you'd like to have a call, there's a QR code here where you can book a call with Lauren.
Yeah, so if you're interested or if you have any other questions or you want to speak with me directly, feel free to scan that QR code. However, I am the person on presentations that never can scan it on the fly. So I do have my link. I will actually drop it right now in the chat so that everyone has it. Maybe this is dangerous, but I'm going to do it anyways.
Lauren, while you're doing that, would you like me to open up the bonus shares? So
Yeah, we didn't have, someone asked about the bonus shares. So I'm actually just going to pull that up right now. I don't think we had it on
yeah,
this deck.
no, I have it up on my screen. I can share it if you want.
Oh, okay. Yep.
Uh, Share.
So essentially the bonus shares, for example, let's talk about a $25,000 investment. There's really four tiers. It kicks in at 25, then you have 50, then you have 100, and then 250. Now you're essentially getting a percentage of bonus shares. At 25,000, you're getting 4% bonus shares, anywhere from 25 to just under 50. Now, obviously, 25,000 is going to give you 100 bonus shares. Essentially, each share is worth $10. And so you're getting $1,000 extra dollars that you're both accruing 8% on, and you're able to request redemption of that $1,000 at the end of the 4-year term. So you're getting paid on that, 8% on that, plus at the end of term, you can redeem for the cash value. That again increases at 50, 100, and 250. And I think, Jason, you asked this question. If you have any specific amounts, or if anyone has specific amounts they want me to run through our bonus share calculator, feel free to email me and I can send you a breakdown of what that looks like. It'll show you how it affects your monthly and whatnot, and what your total IRR is at the end of the 4 years.
Yep. You've mentioned it, but I just want to be clear. If you invest 30,000, then you get 120 bonus shares. It's not 100 shares. And you've mentioned,
Yes.
but I just want to be clear that it's a percentage of that investment. Another question popped through about UBIT and UDFI if you're using a sole 401k or self-directed IRA. Again, we've stated several times that we are not tax advisors, but the company is a C corporation. And again, it's my understanding that as a C corporation, because we are paying corporate taxes, then people who invest with a deferred retirement account are not subject to the UBIT, UDFI, but please always talk to your custodian.
So with that, I think, do we have any more questions? This is where we'll really just open it up. I don't think we had any other slides on there for today.
Nope, it was the last slide was A and a thank you.
So again, feel free to ask any other questions you have right now. If again, you were interested in any sort of past presentations on due diligence, on ask us anything on case studies, whatever it might be, again, those are on our website. You can go to 70investments.com and see those. I did drop my calendar link if you're interested in booking a call with me in the chat of the webinar. So you should have seen that pop up. And then I wanted to say that I believe our next webinar will be in October, and we're looking at doing one on case studies. So if that's something you're interested in, we do send them out. If you're not on you're all on our email list, I assume, since you're here, but we do send those out every Saturday. I know sometimes I get emails and I don't read them, but if you are interested in kind of the mechanics of what we do, send out a weekly case study every Saturday. So you can see that as well. Looks like we have a few more questions. How often are the distributions to investors? We pay monthly distributions to the investors. And then, hold on, and then someone asked about the Reg D. We also have a Reg D for accredited investors only. Those returns are a little bit differently structured. So the minimum investment there is 100K, 9%, 250K, 10%, 500K, 11%, and the same kind of structure as far as monthly, annualized paid monthly, and everything is the same there as well. It's just a higher barrier to entry and a different coupon structure because there are no bonus shares.
And the other thing I just want to mention is those investors are investing in the same assets as the Reg A offering. So everything is invested in CWS investments. It's just two doors to get into the company, whether you come in through the Reg A or the Reg D.
Yeah. And if that's something that you just heard me spout that off and you're like, wait, that sounds like more my speed, feel free again to book a call with me and I can walk through that as well. So any other questions? Okay, just following this up. With that, no other questions here. We almost took up the whole hour. I was actually shocked because we were flying through it at the beginning. But any other questions, again, feel free to reach out to myself. We also have Invest at 7E, Katie and Tony, who are awesome. Some of you might be investors that have spoken with them and know that when you call, that's who you speak with. So Thank you guys so much for joining us and have a wonderful Wednesday.
Thank you all.
Bye.
Bye.